Very good morning. How are you all keeping? Amidst coronavirus issue, please stay home, stay safe, but keep studying. See, we are in a world with a lot of events going on now. I feel the world is full of interesting things. Oil prices have gone to negative. Many students have been emailing me, how is this possible? Wonderful. I really appreciate students who are asking inquisitive questions like this. Well, we have passed last 4 weeks. We have covered two different types of derivatives. We have done much with the forwards. We have done much with the futures. Now, another big segment of this unit is the options. Options contracts going to go on in week 5, week 6, week 7, week 8, probably week 9 also. So I would say about 50% of this unit content is made up of options markets. So listen carefully because this is the first lecture which will be starting with the mechanics of option markets. Chapter 10 in the textbook. Please refer to the textbook as well as my unit slides and listen to my lecture carefully. I will open up a Zoom session this afternoon, possibly at 3 o'clock, for you to engage with me and ask any questions regarding this week's lecture or last week's tutorial, almost anything. I have released the take home assignment number 1 yesterday into the Moodle. Please go through it carefully. You have got about 9 days, but you don't have to take 9 days to do it. Gradually, you try to complete it. Once you complete, submit it back to me as soon as possible because if everyone wait for the last minute of the deadline, that is by 30th, 5 p.m., 30th April, all will be trying to load it up and there will be a congestion. So take your space, like how we are doing social distancing now in the physical world. Try to do it and get rid of it fast. So I would believe that or expect that students will do the take home assignment all by themselves without cutting, basing other materials or copying or discussing. You can discuss, but don't borrow brains. That's what I mean. Okay, let's go into today's lecture mechanics of options market. Let us see what are the learning objectives. Discuss basic options contract positions. These are the naked positions where we don't combine with any portfolios, just options by itself, and the key institutional features of the option markets. The very important thing in option is that you must be able to draw the payoff table, payoff diagrams, or profit diagrams to the options positions. We have got so many positions which we're going to learn today. Just same like futures or forwards, we have got the long position, we have got the short position. We will see one by one. Third objective is to identify and discuss factors that affect option prices. Option prices, what I mean here is the cost of the option, the premium to buy the option. Okay. Now let us get into the lecture. Learning structure today is definition of options, basic option positions we're going to learn, and their payoffs or profits. Payoffs has the gross nature, profit is the net nature. Some institutional features of option markets we'll discuss. Then we'll get into option pricing, the factors that affect option prices. And we will also discuss the two types of options styles. We have got American call option, or we have got American options and we have European options. So specifically, American call options on non-dividend paying stocks are something quite unique. Let us look at it later. Okay. Well, the big $1 million question here is what is an option contract? Okay. What is an option contract? I would define it same like insurance. Let's say I want to travel to overseas in the normal times, not now. Of course, now is the coronavirus time, all restricted. Well, let's say about a year before, I wanted to travel to US and I buy a travel insurance. Why do I buy a travel insurance? I buy travel insurance and upfront I pay a premium. Let's say I'm going to America for 1 week and I may buy a travel insurance. Depending on the country, depending on the number of days, the premium will be calculated. Maybe I will be paying about 150 ringgit premium upfront. What is the insurance for? Travel insurance is to protect my health there, any uneventful accidents or so, luggage loss in the flight, flight delays. I can come back and claim because these are the things which you want to hedge against an insurance. So once I buy an insurance, I'm buying a right to claim in future. It doesn't mean that if I buy an insurance, therefore I have to go and get into an accident. No, I buy just to protect myself against any uneventful situation. Okay, so I go, I'm happy there. I stay there 1 week, no coronavirus, nothing. I came back safely. So what happened? I didn't claim anything because nothing eventful. So my premium, what I paid is a sunk cost. I already paid for it. I bought the right. But if anything has happened to me, and let's say it's claimable, then I will exercise my right. I'll exercise my right on the insurance, saying that, okay, you covered me so much, so much, so much, I paid you the premium. So therefore, this particular event, okay, I met a small accident there while getting into the taxi. So I paid about 1,000 US dollars to treat myself. So I want to claim. So that is what we call it as a exercising our rights. So similar to that, if nothing is eventful, we let it lapse by that. Of course, the premium paid is sunk cost is gone. But something happens, then you are enforcing or you are exercising your rights. So same like that. Option contracts are derivatives which can be written on any listed underlying assets. It can be stocks, it can be commodities, it can be indices of interest rates, indices of capital markets, currencies, foreign currencies, almost anything. Okay, let us see what's a call option. Here we have these two words, call and put. Call is to buy something. Call option is an option contract to buy something that is underlying at a predetermined price, that is a strike price which you are entering now, which you are negotiating with the seller of the option, and a future expiry date. So you can long a call option. That means you are a buyer of the call option because you are intending to buy something in a future date and you want to lock in the price at the strike price. Assuming that the price of that particular asset could go beyond the strike price, that means the writer of the option is promising you to sell that underlying to you at the agreed price. Okay, so that's what goes on. So likewise, we have got a put option. You can still long a put option. It's an option to sell something, the underlying, at a predetermined price, that's the strike price you fix today, at a future date of the expiry. Well, call option, you are trying to protect against the price going up. Put option, well, come back again. Call option, you are trying to protect the prices going up when you're intending to buy something in the future. Put option is an option that you are trying to protect the price from falling when you have something and you want to sell it in the future date. Okay. So you can buy a call option or a put option. Please don't confuse here. Call option is an option to predetermined price, strike agreeing a strike price to buy something in a future date. Put option is an option to fix a price, a floor level price, to sell something in the future date. You can buy either a call option for the purpose of you to protect buying something in the future date. You can buy a put option with the intention to fix a price for selling something in the future date. Well, these two options are the options which we use for the purpose what we are intending to. As a holder of the option, you buy option to protect yourself. Of course, we have got the other side, we have got a person who is shorting the options to you, that we call him as a seller of the option or a writer. Okay, we have got two types of option styles. A European option, very famous. Most of the options which we're going to discuss today and in the next few weeks are going to be European options, unless otherwise is stated clearly it's an American option. If I didn't say anything about the option style, then it is definitely a European option. Can be exercised only at the expiry date. See, at the maturity, you can exercise it only at the maturity. Because let's say you buy a call option to buy 1,000 barrels of crude oil, not considering it for now, let's say at $50 per barrel. Let's say, and your option should be exercised by September 30th. While in between, if the crude oil price has gone up much more higher than the strike price, you will be the inclination to exercise it, but you are not allowed to exercise anything before the expiry date in a European option contract. So you have to wait until the expiry date, then you can exercise your rights. But American option style is an option which gives you a chance to exercise any time prior to the expiry or up to the expiry date. American options allow you to exercise immediately. The minute you know your underlying asset price for a call option has gone beyond the strike price, where we call it as you are in the region of in the money. So you can immediately exercise it. No need to wait until the expiry date. Well, I told you there are two parties involved in the options. Two sides of every option contract is long position taken by the option buyer or called as a holder, or simply the option holder. And a short position is taken by the option seller, normally a financial institution who are licensed to sell options. Not anybody in the street can sell options. Option selling is because they have got a very high commitment to pay later on. Their liability is large. So short positions taken by option seller, or we call it as a writer. So in total, if you look at it, how many basic option positions are there? You have got call option, you have got put option. Both have got times 2 because long position, short position, that means it becomes 4. You have got a European option, you have got an American option, 6 altogether. Well, well, we have seen the very basic ideas about options as derivative. Well, let us get in basic definitions of the option. As I told you, an option contract is a financial security that gives the holder the right to buy something if you are having a call option, to sell something if you are going for a put option. But that does not mean there is an obligation. See, like forwards, futures, when you enter the contracts, there's an obligation to close out. There is an obligation to take delivery in the forwards. There is an obligation to close out the futures. Here, there is no obligation. You are free to do a lot of things. If you are in the exercisable position with where the option at the expiry for European option, if it is in the money region, that means by exercising you should be earning something. Then you can exercise. But let's say the underlying price is below the strike price, where you can buy it in the market, you just forget about the option. You don't need to exercise it, just like the insurance I told you. If nothing happens to me in the travel, I don't come and claim anything. I just forget it. Of course, the rights, the premium what I paid to buy the right is paid forever. Okay, here an option is a financial security that gives the holder the right, but not an obligation, to buy or sell a specified quantity of a specified asset. We have got these are specified. You must know what is that asset underlying exactly, the specifications and all this, and how many units or what volume at a specified price, that is the strike price, which you fix it now itself. You can tell your option writer at what price you want to fix it on or before a specified maturity date. So basically, you can go to the option writer and tell, okay, I want to buy, say, 2,000 tons of crude palm oil at a given price. Let's say you want to buy it at $2,000 per ton by September 2020. Assuming that by September 2020, the crude palm oil price may exceed $2,000 per ton. That is your idea. If it actually exceeds, then you are in the position to exercise your rights. But let's say by September 2020, if the crude palm oil price per ton is below 2000, and let's say you're interested in buying the palm oil, just go and buy it in the market. Forget about the option. No obligation. That's what you mean by holder holding the right, but not an obligation. Okay, go into the specific definition now. Call option is the right to buy, I told you. Put option is the right to sell. Either you can be in the bench of a buyer of this either of this option, that means you long a call option or you long a put option. Of course, the other side of the bench is somebody who is shorting a call option to you, or short a put option to you. Okay. And talking about the styles of option, on or before is the American option. Only on the majority is the European option. Okay, when I tell you specified price, it is a strike price, or some books call it as exercise price. That is the price we are fixing now. Basically, in our equation, we use the word K there. K is the exercise price or strike price. Specified date is the maturity date. What is the date of the expiration of that contract, that particular option contract? As I told you just now, we are now in April. You could be buying a June option contract, that is the nearest. Maybe you'll be buying a September option contract. Specified asset. What is the underlying? What is the option written upon? Options have to have an underlying, otherwise the option is nothing. So it's a contract. Contract written upon what? Crude petroleum, crude palm oil, US dollars, could be a specified single asset, the single stock asset, or could be a stock index, anything. Okay, so we have got these positions, two positions. The buyer, the holder, holds a long position. The seller or the writer holds the short position. I hope you are clear by now about these basic definitions. Okay, see, further down again, I will try to introduce you the fundamentals of the option. See, last three slides are talking to you the same thing again and again, trying to define to you how to interpret these option contracts. Type of options. You have got call options, you've got put options, you've got European options, you've got American options, and all these you can either long or you can short. You cannot be shorting because to short options you need to be a financial institution with a lot of reserves who are licensed to do so. Okay, coming a call option is having the right to buy. And as I said, at the exercise K, we use the exercise price or strike price. Usually, we use the symbol K. Whenever I say K, K is the symbol for exercise price. Or a put option is having the right to sell an underlying asset at the exercise price or strike price, which you fix now. Okay, well, an European option, as I told you, can be exercised only at the end of its life or at the maturity of the options contract. You can't do anything before that, unless you want to give up the option, because you already paid for it. Whether you want to exercise it or you want to throw it or you want to do what, it's up to you. So, an American option is the option that gives you the right to exercise anytime up to the up to and including the end of the life of the contract, up to the maturity date. Of course, the dead end is the maturity date, but you can exercise your American option anytime before that. You can exercise immediately also. Okay, options fundamental still. We'll go into the positions of the option. Option buyer or holder, either he can long a call or he can long a put. Why do you long a call? Long a call is buying the right but not the obligation to buy the underlying asset at the strike price which you have agreed with the seller. I mean, seller of the option. You fix the price now with the idea that the price of the underlying might be going above that agreed strike price. So you have got the right to buy it at the strike price and immediately selling in the market at a higher price, or just offset the difference with the seller of the option. Okay, you long a put. You long a put means you are buying the right but not the obligation to sell the underlying asset at a strike price. Let's say you have got a stock index and your portfolio is about $500,000. You don't want the portfolio value to fall. So you can buy a put in the stock index. If the index falls, then you can sell at the strike price and make the difference to offset the loss in the value of the portfolio. You will see it later. While the other party is the option writer or the seller, so he shot a call, selling the right but not the obligation to sell the underlying at a strike price. He is in the other side of the mirror. So while you are buying the right to buy something, he is selling the right to sell something. Short a put, selling the right but not the obligation to buy some underlying asset from the long position exercise. Okay. Well, we will go into something more detail now. Long call option example. I tell you, when you long call option, that means you are buying a call option to buy something in the future date. So let us see very clearly. An investor buys a European call option. See, European call option, which means that you can only exercise at the maturity of the option. An investor buys a European call option to purchase 100 shares in 4 months at a strike price which you fix today, the K is $100 per share. Why did you fix it to $100 per share? Because currently the share price is $98. S0 is $98. and you believe that it might go up more than $100. Assuming that there are some good news about this particular share, so you are expecting the share prices to soar or to be bullish above $100. So you set a price at $100 because the nearer it is to the current price, the higher the premium you have to pay. The current share price is $98. The price of an option to buy one share is $5. You are paying a premium of $5 per share here, and there are 4 months to maturity. So that means your expectation in these shares is that by next 4 months, the share price should be in the market price of the share, that is at the ST, that means spot at the time T maturity, should be more than $100. So you can exercise your option. But you have paid $5 upfront. That is your cost, which you usually say cost of the option, price of the option. Don't mistake, price, strike price is different, option price is different, and the maturity price is different. You got three different prices here. Okay, at the expiration of this option, the share price ST happened to be $115 as you expected. So as the ST, the final terminal price, is more than the strike price K, the investor will exercise the option. Because this is where we call it, when in long position, when you are long call, if the ST is above K, that means you are in the region of in the money. If the ST is equal to K, you are at the money. If the ST is below K, then you are out of the money. At the position of out of the money, you won't exercise the option. You just give it up. Or at the money, you are indecisive. At the money means the final price of this underlying asset and the strike price is same. If you don't exercise, you lose your $5. If you exercise, you make nothing. You still lose the $5. But if the ST is above K, you are very happy that morning. When you wake up and you see the ST at the expiry of this option, the final price of the spot price of this particular underlying, the stock is far more than strike price. We can see you smiling your morning. The investor will exercise the option. So in the case of physical settlement, this involves the investor paying a strike price of $100 to receive 100 shares, which is worth $115. He'll receive the 100 shares by paying $100, which he can immediately sell in the market for $115. Look at that. So what gain you make? So $115 minus 100 times 100, $15 times 100 is $1,500. That is your gross payoff. In the case of cash settlement, this involves the investor simply receiving $1,500 from the seller of the option. Rather than you going collecting the shares and going and selling it again, you just go to the option writer and tell, hi, see, you agreed to buy it, sell it to me for $100. Now the price has gone to $115. Pay me the difference. When you look at it in the net position, remember you have got a cost which you already paid upfront. $5 for 100 shares is $500. So you are earning, you are receiving $1,500, but you have paid $500. So your net profit is $1,000. Does that make sense? Clear? Okay, looking at it in the diagram form, you see in options, you have to interpret the options positions, the options processings, or the mechanics of it in three different ways. One, you can explain. Second, you have to draw the payoff table. Third, we can draw the payoff diagram. So here, Long calls profit diagram. Profit from buying one European call option with a price of $5, strike is $100, and ST is 150. You can see very well. Until the price reaches 100, you are losing the $5 premium which you paid. That's why it is negative. The graph is in the negative 5. But when the price, your underlying asset price at the maturity goes to 101, you are recovering $1 from your premium. 102, you're recovering $2. 103, 104, up to 105. That's where the break-even point comes in, where you make no profit, no loss, zero. Why? Because you made $5 from the difference in the price ST minus K, but that $5 is gone for what you have paid as a price, cost of the option. So when the ending price ST goes above the 105 benchmark, then you see the profit region comes. Here in this case, I draw a red line there at 115. That means you have made a substantial amount of profit there because your break even was 105. You are earning 115. 115 minus 105, you got $10. Very simple mathematics, isn't it so? Well, you have seen how to draw the option diagram. Long calls profit diagram is here. When I say profit diagram, you are taking into account of the cost. Well, generalization of the payoff and profit function of this long call, which we saw just now. You always will listen this word payoff. You'll be wondering, what do you mean by payoff? Payoff is defined as the cash flows received or paid when the option position is liquidated at the maturity. Use a European call option or put option is liquidated at the maturity. Alternatively, it would have been an American call option is whenever you are exercising your option, it is liquidated. Let ST be the asset price at expiry. With at the initial stage, it is still a variable. You don't know what will be the ST. Always. You saw these in the forwards, you saw these in the futures, and now you are seeing it here. ST is always a variable because at the inception, today's date, you won't know what will be the asset price 3 months later, or 4 months later, or 5 months later. Nobody will know. You don't know. I don't know. The God don't know. Okay. K is the strike price or exercise price, fixed at the inception of the option contract. So coming back to our example just now, the payoff for a long call is that normally the payoff generalization equation is maximum of ST minus K must be more than zero. If ST minus K becomes a negative, we don't write a negative function. There we write it as zero. But you are in the money region if you exercise it. That's why I say that the maximum of final price, that is ST, minus strike price K should be greater than zero. That is the payoff for a long call. Meaning of the payoff is ST minus K. If ST minus K is more than zero, it is exercisable. Or if ST is above K. And 0, if ST minus K is below 0, the last point is 0. You won't write negative what. So, or the ST is below K, where you won't exercise first of all. It's 0 because you won't exercise. Profit for a long call is maximum of ST minus K. That is the gross part of it. Then you minus the cost, then it becomes a net. In our example just now, maximum of 115 was the exercise ST minus K 100. That gives you $15. But you must not forget the cost you paid, the premium, $5. So 15 minus 5 is $10. That's what I told you earlier. You get it now clearly? Okay. Now we look at the other one, long put option. So far we saw long call option, that is to buy something in future. Now we are looking at long put option example, which is almost the reverse of what you saw earlier. An investor buys a European put option to sell. Here it is to sell, not to buy. It is to sell 100 shares at the strike price of K, which is $70. The current share price is S0 is 65. See, current share price is 65. He is fixing it at 70. The price of an option to sell one share here is small p, is the premium, not p is for the premium, is the cost for a put, is $7. And there are 3 months to maturity. See, now it's 65. You are holding the shares. You are trying to sell it at 70, thinking that it may fall anything below 65. If you are able to buy this kind of an option, which is wow, above at the money, this is wonderful because you can, if it's an American option, you can exercise immediately because you will get $5. But it's no use because your cost is $7. Okay, let's say assuming this, at the expiration of this option, the share price has come down to $55 as intended. So ST is below K. For put option, the ST has to be below K to exercise. Because when the final price is below your strike price, you can still sell it at your strike price and immediately you can buy back at the ST. So in this case, the physical settlement, this involves the investor receiving the strike price of $70 per share. He'll get it as money because buying 100 shares, 70 times 100 is 7,000. Okay, 70 times 100 is 7,000. And delivering the same share which is worth only $55. The gain is 70 minus 55 times 100 is 1,500 in this case. In the case of cash settlement, this involves the investor simply receiving $1,500. But he has originally paid $700 for his price. So therefore, 1,500 minus 700, your net profit is only 800. And still you made a profit. So do you get it clearly? Long put option. Okay, this is the diagram for long put option. Profit from buying a European put option. P is $7, that's the cost of the premium. Premium of the option is $7. Strike price K equals to $70. And the ST, the final price, is 55. So here, until the price is above $70, you are in the loss region of -7 because there is a premium you paid. The minute it falls below 70, that becomes 69, you are recovering $1 from the $7. 68, you are recovering $2. So by the time you reach 63, that is where the break-even point comes because you have recovered all the $7 from your profit. Then when the price falls below 63, you are making profit. So in this case, the price has fallen to 55. That means you are making a substantial profit there. Okay, let us see. Payoff for long put. The function here, okay, is max K minus ST. Last time you saw in the long call, it was ST minus K. Now it is K minus ST. In the put function, is K minus ST because strike is considered to be above ST. Maximum of strike price minus terminal price should be greater than 0. Profit for long put is therefore max of K minus ST must be above 0 minus the P, that is the premium of the put. Meaning that when ST is below K and the difference is above 0, the put option can be exercised. The put option is exercised only when the ST is below K. Call option is exercised when the ST is above K. Remember that. In our example earlier, You got $70 per share minus 55 minus 7. You're making $8 per share. In this case, you are talking about 100 shares, times it by 100 will be 800. Okay. Okay. Now we look into the short option positions. Thus far, we saw long call option, long put option. But now we are going to the other side of the bench, where short option positions. The sellers of the options, as I told you, cannot be anybody, should be financial institutions who have got enough reserves to pay the liability which they are in. They have got a lot of contingent liability by selling options because the profit you make in the long position are the losses with the short position have to see. So who is bearing the losses of those examples which we saw so far? Answer: the call writer and the put writer in the short position options are the ones who make the payments of the profits which you made as a long position. So is that logical? So if you think that short option position or writers will be always at a loss, why do they sell options? Well, you see, option writers have got limited upside profit, that is the premium, and unlimited downside loss. And yet they sell options. Why? Because research has shown 85% of the time options are not exercised. So the writers can make the money from the premium. Same like insurance sellers. You go and buy an insurance saying that if anything happened to you, the insurance company have to pay you. The insurance company have to pay everybody who is already meeting a bad health condition or death. So how does the insurance writers make money? So actually it is understood that over the years and years and centuries, not all the insurance holders or policy holders claim at the same time. So they claim at variable different times. The same thing here, not all the options are exercised. There are 85% of the options, you won't believe it, 85% of the times options are lapsed without exercising. The writers receive cash upfront as premium or the price of the option, but as a potential liabilities later. The writer's profit or loss in the reverse order of that of the purchases a long position option. Payoff functions for call writer, as I told you, payoff function for a call writer is minus the maximum of ST minus K. This is the inverse, you see. This is in the inverse position, that's why we put a minus max or minimum of K minus ST. So payoff function for a call writer is a max of ST minus K plus C because he makes that call premium. There is profit function for call holder. What is that? Payoff function for put writer is the minus max of K minus S. Must be more than 0. Will be less than 0 in case we already put a minus mark there. Payoff function for a put writer is minus max of K minus S T. K minus ST should be more than 0, but you already have a minus function there plus P. So profit function for a put holder is whatever loss you're making plus the P. P is the one which counterweights the loss. Okay, short call just now. Coming back, do you remember our first example in the long call? Profit from writing one European call option where The cost was $5, the premium was $5, strike price was $100, and the ST was 115. So it is the reverse graph of the long call option. See, can you see now? Until the ST is below 100, the call writer makes the profit of $5. That is his premium. Once the once the price ST reaches the $100 mark, he loses his premium $1 by $1 by $1. By the time he reaches 105, entirely all his profit is gone. His earnings or gain is gone. After that, if the ST is above 105, in our case it was 115. So there was a loss for the short writer. How much does he lose? So it's 115 minus 105, $10. Plus $5 he made. So he makes only $5 loss. Why? Because 115 minus 105 is $10. There's a loss. He lost $10. But he already earlier made $5 per share. So 10 minus 5 is 5. Okay, profit from short put. Look at this. This diagram is the opposite of the short call. Writing a European put option. Option price P is $7. Strike is $70 and the ST was 55. You see here, until the price ST is above 70, the writer makes $7 for each share. The minute the price falls below, so that's why a put option is always for the negative direction. And the price falls below 70, it becomes 69, 68, 67, until it comes to 63. When it comes to 63, he has lost all the gain which he made. The $7 gain is lost here. But in our case, the price fell, breached until 55. That means 55 minus 63 is how much? 55 minus 63. 63 minus 55. 3 here, 5 there, $8. Here, in this case, you don't minus anymore because you already taken the account of the break-even. Otherwise, it is 70 minus 55, $15 minus $7 is $8 per share.